Hi everyone, welcome. Sorry, we're slightly late starting. I'm Bridget Jackson, divorce relationship coach at Equalexes, and I would like to warmly welcome my guest today, Trent Bradley. How are you?
Hey Bridget, thanks for inviting me today.
No problem at all. So Trent is the founder and director of Luminate Financial Group. And one of his specialities is mortgages. So today we're going to talk about all you need to know about mortgages. So Trent, tell the viewers about yourself, briefly. Trent likes to talk. So. Yeah, exactly.
My background is originally I was involved in sport and rugby for a living. Then I went through university, then from university went into the bank fraternity. Did my apprenticeship with the good old National Bank, Black Horse, which was one of the things I'm really grateful for. Did a really good apprenticeship with National Bank and went all the way up to commercial manager there. And then I had another couple of roles in 1998 going out as a mortgage broker. And I've had 21 years out running financial consultancy and building up to a consultancy and a finance company.
Finding it hard to hear you a bit.
Okay, what about now? Is that better?
That's better. Yeah, great. So at the current time, with mortgage holidays about to end October, November, with obviously the COVID crisis, it's on everyone's lips. So mortgage holidays, are they a good idea? And should people be extending their mortgage holidays because they're still going through tough times?
It's a good question, and been really concerning. A number of my clients come to me with mortgage holidays without really understanding what they're taking on. From my perspective, they're just a toolbox. So what really needs to happen is when clients are looking at these options, they need to have to explain properly, really understand the ramifications of those. Do you
want to put your headsets on? Headset
cool.
on.
Yeah.
Sorry, just so everyone can hear clearly what you're saying.
Okay. All right, let's give that a try. Captain Spock on the Starship in.
There we go. Take two. So mortgage holidays.
So in essence, the most critical thing is that people have those mortgage holidays explained to them and the ramifications for taking them on. For example, a lot of people taking mortgage on without really fully understanding how the banks view it. The banks, once you take a mortgage holiday on, the banks put a black mark against your name in essence and put you under closer scrutiny. They also embargo any further lending to you without a significant more scrutiny. So the one thing you'd want to really understand is one, whether you actually have to take a mortgage holiday on. There are other options, there are other shorter term options that can be better for an individual client. From my perspective, the three most important things that you need to really be wary of, firstly would be the issue of the banks reclassifying your account. Like for example, I had a client who had an approval to buy his ex-wife out of a home. He went and got a mortgage holiday and they immediately cancelled the approval, and that's standard. Okay. The second thing is that when you do a mortgage holiday, you're now capitalizing the interest. So what that means is for the rest of your loan, you'll be paying interest on interest, and that can be pretty expensive. So if we have to do it, we do it, but only should situations dictate or there's no other option. The third thing is there's a number of other ways we can get around that without having to do that. It might just be we go interest only for a period of 6 months as opposed to a mortgage holiday, or it might mean that we get some short-term funding to get by. Like for example, it might just be an extra $5,000 on a credit card, and then we pay that credit card off over a shorter period of time rather than paying interest on interest for 25 to 30 years. It might just be that we do a short-term loan to get through that situation, and that's a lot cheaper way of going about it. Doesn't affect your reputation with the bank, and it's just a more expedient way of doing things.
Right. So really, fundamentally, what you're saying that people need to actually get some advice from the expert advice from the likes of yourself.
Absolutely, a competent mortgage advisor, anyone who's been around the block, who really, or who's got some serious experience. I guess the key thing is that there are no free lunches. Everybody's aware of that. So you just really need to understand the ramifications. Having said that, if you have no income coming into a situation for a period of time, it is and you have to do it. That is a tool in the toolbox. But at the end of that first period of 6 months, for example, we may actually have to stop and have another really serious look at the situation and have a bit of a review. For example, if you've lost a business or you've lost a job and it's not coming back anytime soon, and we need to, for example, retrain to get it to go into another industry, then we may have to, look at some other longer term or cheaper funding options. For example, funding a chunk of interest, or doing another short-term loan for an extended period of time, or it might even be that we consolidate a position.
Right. Okay. So with prices soaring at the moment and interest rates being low, which we'll talk about further in a minute, what is the criteria for people to obtain a mortgage, and what are the fundamentals that they need to be aware of, and
Cool.
the fees that are associated with obtaining a mortgage?
Okay. Two things I just probably take you on a little bit there, Bridget. The first thing is prices are not soaring, but they're very stable. Okay.
Right, okay.
They've strengthened a little bit, but prices aren't soaring. When we're buying property, we still need to buy on fundamentals, and not panic buy or not go out there. Yes, there's some yes, the market is strong at the moment, and I wouldn't say it's soaring, but it's certainly really stable, and it's strengthened a little bit. All right, prices have definitely firmed in certain areas, and there are some areas where we have seen some significant increase. But in terms of your other question, what is the key thing with mortgages at the moment that I've seen? I've been in mortgages 21 years. In the last 2 to 3 years, things have changed considerably, and in the last 6 to 12 months, we've also seen some changes. The most significant of those is the information required from the bank. There's only 3 parts. The reason why I'm a mortgage broker and or a financier is because it's a pretty simple job, really. There's only 3 things that we're ever looking at when we do a lending application. What's my security? How are you going to pay me? And who am I dealing with? That's it. All right. So, but traditionally, the banks have always been obsessed with what's my security, or how much equity have you got. Now the banks from the GFC are more concerned with how are you going to pay me, and the information requirement for getting loans approved now is far more significant. And as an advisor that's been in the industry 21 years, it never ceases to amaze me. The banks are not only obsessed with getting every last bank statement, they're also very focused on reconciling any debt that's declared and going through the bank statements and making sure there's no unsecured debt. And that's because the regulations now are so much tougher on the banks, making sure they've assessed your debt servicing position and scrutiny. So it is a lot more information required now. But if you're dealing with the right advisor, they should be able to tell you up front in that first meeting exactly what's required.
Okay.
Your last question was fees, and that's again another one. It depends on what you're dealing with, or in terms of what type of funding you're doing. There are fees to pay in certain applications, but in the current environment, especially with spring mortgage campaigns, there's not only, if you've got a good mortgage advisor, there should not only not be fees, but there should also be some incentives to incentivize you. Banks are paying incentives to get new clients on board, and that's where you really need an advisor who's got some serious volume going through their books to really be able to advise you what we can achieve on a from a bank on a mortgage application. Just want to explain that quickly because there'll be a lot of people out there. So upfront fees on basic loans at the moment in the current environment, there should be none unless you're doing an outside the square transaction or a bridging transaction. Secondly, the banks are paying incentives right now, so they will give you a contribution towards solicitor costs, and that'll be a cash sum paid to your bank account on settlement as an incentive to get you on board as a client. With some of our clients, that's as high as 0.6 or 0.7%. So for every $100,000, $600 to $700. So for $1 million loan the other day, I got a cash incentive out of a bank of $12,000.
Well, that's
Okay,
fantastic. It all helps, doesn't it? You know.
it does, but it just your choice of advisor should be able to give you some upfront, right in that first meeting, tell you what you're likely to get and what you're likely to have to pay.
Yeah, great. Now let's talk about interest rates, because they're at a pretty much an all-time low for quite a while, aren't they? You know a lot more about this than I do. Obviously, you're the expert. But what is going to happen in terms of interest rates over the next year or two, do you think?
Well, after 21 years in the business, I don't think I've ever been made to look like more of a petrol pump attendant than the question on interest rates. And unfortunately, my flavoured crystal ball is the same flavour as everybody else's. So when we are choosing interest rates, I tend to go back to principles to choose interest rates. But what we do know about interest rates at the moment is that they are likely to soften a little bit more. As to how much, we're not sure. The economic information that we're getting out of the US at the moment is scratchy at best, and in terms of predicting with real confidence, I'm hearing numbers quoted by certain economists that shall remain nameless, Bridget, that you know, that we could be under 2% by Christmas time, but I'm not entirely confident. But we are expecting a 10 to 15 basis point discount. But I need to reiterate that is it is a bit of crystal ball gazing. When I talk about interest rates to my clients, I like them to think about two things. I like them to ask the question: are interest rates high or low right now, and are they going up or down? If interest rates are low, and we know that they're going to increase from now, then those mid to longer term rates can make good choices. If interest rates are going down, then we're fixing short. When we're in a soft market like now, where we know potentially there's going to be, we know we're in a low interest rate environment, then the lower shorter interest rates can be good buying. So I've got a lot of people fixing 1 year fixed right now. The cheapest interest rate through our practice at the moment is 2.45, 2.49. At non-banks, we're as low as 2.2. That's extremely cheap. In 30 years, in the last 30 years, that's by far and away, the lowest that certainly I've seen in my career. And to put that in perspective, people with COVID are saying, why is this house market? Why in the middle of COVID is the house market strengthening? And to me, it's pretty obvious. If you had an $800,000 mortgage when September 11, when things crashed, we were financing around late 7%, and you were paying $60,000 in interest on your $800,000 mortgage. In the GFC, we were late sixes, and you were paying $48,000 on your mortgage. Today, when you're paying 2.5% on your mortgage or thereabouts, you're only paying $20,000. So you can see that even though things are really bad in the environment, because interest rates are so low, that makes a very significant. So that means if you've got even a policeman and you've got, when I say a policeman or a school teacher with an $85,000 and a $65,000 salary, if Dad, the policeman, loses his salary, for example, on 85, you've got someone with 65. When your interest only is only $20,000, that person can still sustain a mortgage, an $800,000 mortgage, which is phenomenal. Okay, and still feed the kids, and hopefully then we can boot the husband back to work and get another job.
Fantastic. So what is the difference between bank lending, second tier lending, and third tier lending?
It's just two simple things. It's number one is risk, and number two is price. So the different entities take on different risk profiles. So a bank will take on, can I just go back and finish that one thing about interest rates, right? Because there's something important I'd really like people to understand. So there's two things when you're selecting your interest rate. So I just want to make sure, because this is something that I want people to be able to know and use when they're choosing their interest rates. Because you do come under a bit of pressure, and there is a bit of anxiety when you're choosing your interest rates at the bank. So what you do is you come back to time and proven principles. Are interest rates going up or down? Are interest rates high or low, and are they going up or down? If they're low, we're going to be fixing longer, and if they're going up, we're going to be fixing longer. But if they're going down, we're going to be fixing shorter. The second thing is just to ask yourself the question: what's my comfort level? So in terms of in terms of interest rates, for example, when you're choosing, you've got a $500,000 mortgage, and you're saying, well, what's my comfort level? Well, simply, if interest rates go up 1 or 2%, like right now we're at 2.5%. We've seen interest rates comfortably have averaged over the last 20, 30 years at late sixes. If interest rates went up 3 or 4%, what would that do to my repayments? And just work out what you can realistically, what risk you can take on. So, for example, a $500,000 mortgage, if interest rates increase 2%, that's an extra $10,000. That's an extra $200 a week. So, I'm using two principles when I'm choosing my interest rates. I'm having a look at whether they're high or low, and are they going up or down. And if they're high, then I'm probably fixing short unless I know they're going up again, and I may fix a bit longer. But if they're low and I know they're going down, I'm going to be fixing short. If they're low and they're going up, I'm definitely fixing longer. For example, you can get a 2.8% 5-year fixed mortgage at the moment, and for my property investors, that's an extremely good option for them. And then lastly, just what's my comfort level? So going back to that covers that interest rate selections scenario. What's my comfort level? If interest rates go up 1% on a $500,000 mortgage or an $800,000 mortgage, that's $8,000 a year. That's $130 a week. How does that affect my budget? And I think that's really important. And certainly the banks are doing a lot more of that sensitivity analysis now. The next thing, what's the difference between banks, second tier and third tier? I think for most of your people, that won't be an issue. We're all dealing with the banks. We all want to deal with the banks. But the difficulty with the banks is that their risk profile is narrower to a lot of other funders. So the second tier and effectively third tier organisations take a far greater risk profile, and the information they require or their scrutiny is less. But then for that risk, additional risk, they charge a higher premium. So the key thing I think for most people to know is that, or most important thing for people to know is that when the bank says no, that's not your only option. Now, when you get stuck out of the bank, you feel like a naughty school kid that you've done something wrong, and oh no, I'm in the second tier. But in actual fact, it's just a tool in the toolbox. And again, if you've got a really good, competent mortgage broker, they should be able to have a look at your risk and assess that risk and give you your options. And of course, every time we fund, we want the cheapest option.
Yeah, great. Okay. So what should people look for in a mortgage broker? What are the fundamentals?
Well, that's a great question. I can tell you the two things that really upset people consistently, and that upset me consistently, right? Then the two things that we really want, the two greatest attributes in a mortgage broker that we really want is, number one, they got to be able to communicate. All right, got to be able to, they got to answer their phone. If you're dealing with someone, if you're in a really important transaction, probably the largest, most important financial transaction that you're ever going to be involved in, which is your mortgage, all right, and they won't pick up the phone, there's nothing more frustrating and exasperating. The second thing is that they need to be efficient. They need to be able to turn your application around. In the current environment, the banks are completely underwater with all these COVID applications, with all the additional information they're asking for now. They've got very slow and cumbersome. Through no fault of their own, it's regulation that's being placed upon the banks, and they are very, very slow. So if the bank's really, really slow, the last thing you want is a really, really slow mortgage broker. So from my perspective, the two critical things is they really got to be a good communicator, and they really got to be able to be efficient. In addition to that, there's a number of other there's a number of other things that I would really want to see. Number one, I want someone who is got a serious level of experience and competence. I don't want someone brand new. I want someone who's in a perfect world. I want
in-depth knowledge of the industry. Yeah.
Well, they just got to have some experience. I don't want a geriatric. I don't want someone who's 100 in the shade, but I do want someone who's had at least, in a perfect world, 5 to 7 years worth of experience. Quite a few of the best mortgage brokers have come out of the banks, and then they're in their own businesses, and they've been in finance. Like, I've been in finance now for 26 years, all right, and they've just they've had a lot of experience. I think that's an important thing. The other thing, which can be quite good, is a referral. If someone refers a mortgage broker to you, someone's dealt with them before and they know what they're like and they've had a good experience. It's another good way to find a mortgage broker. In the current environment, I also think a mortgage broker with a team of people behind them can be a good thing. It's almost impossible now to do the old mortgage broking role, which is be out in the field, taking loan applications, seeing clients, seeing referral sources, and be back in the office, keeping the loan moving forward and being efficient. So I think someone who's got a team of people behind them can also, or who have got a team of people behind them can be a really good asset. And also I think when you're choosing your professionals, I think it's a really good thing to choose someone that you really have some kind of affinity with or that you like. I think I've got a very large client base, and some days I think.
You're quite likable then, are you?
Well, you think it's because you're a genius, but that's not. I'm sure that's not true. It's more that you build a relationship with someone, and people build some level of trust. And I think you want to work with someone that you're comfortable telling, you might want to get really personal about your finances and say, look, we've got too much short-term debt here. We're just not managing things properly. We need you need to be able to get personal with somebody and really go into detail, because you don't want to waste any time.
People don't like to talk about finances lightly, particularly their own. That's really the crux, isn't it? So as a leading expert in this area, Trent, what are your 2 top takeaways for people?
Well, they're a little bit outside mortgages, to be honest, but I think the 2 most critical things after 21 years owning my own finance practice and working in the banks before that, the most critical thing for me with people's finances is 2 things. Number one, I really like to see people take some time at least once a year and sit down with somebody outside of themselves and take an hour or 2 and do some financial planning and think about where they're going financially and what they're trying to achieve. I deal with some very, very high net worth individuals that are just running around making the businesses that they're working for money, making them rich, but never take any time out to sit down. And I really don't think it matters whether it doesn't matter what stage you are in the process or where you're at, whether it's your solo mum with 2 kids or whether you're, a high net worth individual. Taking some time out once a year to sit down and go, right, what does financial freedom mean? Or what does being financially successful mean to me? And where am I currently? And what are the strategies I'm employing to get there? Am I moving forward? That's number one. And now that's not strictly a mortgage broker role, but I think that's one of the financially, that's one of the most important things. If you want my 2 biggest takeaways, that would be number one. Secondly, I think people are so busy now, and the financing equation is quite complex. So I think when you do have a loan that you need to refix, or something comes up in your financial world, stop and take some time and just review your debt. If you've got a really good mortgage broker or a competent operator, you're refixing a loan comes up, because a loan only comes up every 1, 2 or 3 years, and people only change houses on average only 5 to 7 years. So you're not really getting that many what I would call disrupting events that would make you really stop and think about how all your debt's funded. So when a loan or some part of your funding does come up, or you're buying a new car, you get a debt manager or a really good competent mortgage broker and go, just do a review of my debt and see what I can do. And those changes or those savings ranging between it could be from even at 2,000.
Yeah.
I'm amazed at how much we can save people when we analyze, it's not $1,000 or $2,000. It can be thousands. And if our debt's all structured, structured correctly, we're paying it off on the right terms, and it's matched up to our cash flow or our income cycles, then that's the thing that really can save you significant money. People focus very hard and get very tough on interest rates when I'm doing a deal, but then they'll completely ignore their debt structures and how they're paying off their debt over time, when it's that consistency and that discipline that really will serve them well in the other end.
Great. Well, how can people find you? How can people get in contact with you?
We're on either our website, luminate.co.nz, or whether it be all my contact details on there. My email address is trent@luminate.co.nz, and all my contact details are on the website. So luminate.co.
Yeah, I'll put them on this Facebook Live anyway. Well, Trent, I really want to thank you today for coming and having a session with me today. It's been really informative and really educated a lot of people in terms of mortgages, because I see a lot of clients who have a lot of questions about mortgages, and I think it's been really fantastic for people to listen to what you've got to say. You're informed, you're educated, you had experience in the business, and so you know what you're talking about. So I would love you to join me again at some stage in another month or so.
Well, I think it's sometimes on certain specific things we can get into a bit more detail, where I think we can deal with a few more specifics. But I think the most important thing is people. It's really important when you've got a bank person. I think getting a really competent mortgage broker or mortgage advisor, like your lawyer, like your accountant, I think it's very, very important for people to get both a financial advisor and also a mortgage broker as part of their team. And I think in visiting and do like you do, once you're over a certain age, we've all got to go to the doctor for a checkup. I think building that relation and managing that relationship. One thing I would also say to people is, managing your finances is your responsibility. It's not the bank's. Okay, so if you want good financial outcomes, it's up to me. So it's critically important that you pick good mortgage people and then you manage them. Don't wait for them to phone you up to do your annual review. Put it in your diary and send them the email and instruct them when you're going to be doing your reviews. Take control of your destiny, manage your finances, be proactive.
Yeah, great. Thanks so much, Trent, for joining us, and thank you everyone for listening in. If you've got any questions, don't hesitate to contact me. Not about mortgages, you can contact Trent, but if you need help with your divorce and separation, give me a call, and Trent about mortgages. Thanks everyone. Bye now.
Thank you.